White collar crime. White collar crime. White collar crime. Client frauds. 5. Client frauds. 5. Client frauds. A fifth component of white collar crime is theft by an economic client from an organization that advances credit to its clients. Included in this category are insurance fraud, credit card fraud, credit card fraud, fraud related to welfare and Medicare programs, and tax evasion. These offenses are linked together because they involve theft from organizations that have many individual clients who may take advantage of their positions of trust to steal from the organizations. For example, some physicians have been caught cheating the federal government out of Medicare or medical payments. Abusive practices include such techniques as ping ponging, referring patients to other physicians in the same office, gang visits, billing for multiple services, and steering, directing patients to particular pharmacies. Doctors who abuse their Medicaid, Medicare patients in this way are liable to civil suit. Fifth, client frauds. A fifth component of white collar crime is theft by an economic client from an organization that advances credit to its clients. Included in this category are insurance fraud, credit card fraud, fraud related to welfare and Medicare programs, and tax evasion. These offenses are linked together because they involve theft from organizations that have many individual clients who may take advantage of their positions of trust to steal from the organizations. For example, some physicians have been caught cheating the federal government out of Medicare or medical payments. Abusive practices include such techniques as ping ponging, referring patients to other physicians in the same office, gang visits, billing for multiple services, and steering, directing patients to particular pharmacies. Doctors who abuse their Medicaid, Medicare patients in this way are liable to civil suit. Of a more serious nature are fraudulent acts designed to cheat both the government and the consumer. Such Medicaid frauds generally involve billing amounts, setting up kickback schemes, and providing false identification on reimbursement forms. Doctors involved in these schemes are liable to criminal prosecution under federal and state law. It has been estimated that between 10% and 25% of the $100 billion spent annually on federal health care is lost to fraudulent practices. Despite the magnitude of this abuse, the state and federal governments have been reluctant to prosecute Medicaid fraud. A year long study of enforcement practices in 18 states did not uncover a single conviction for Medicaid abuse, and the national average over a 7-year period was found to be 1.5 convictions per state per year. One trend has been to establish Medicaid fraud investigation units. The 30 states that have employed such measures have already disallowed $86.5 million in faulty Medicaid bills. 5A. Tax Evasion. 5A. Tax Evasion. Another important aspect of the client fraud is tax evasion. This is a particularly challenging area for criminological study since so many US citizens regularly underreport their income, and it is often difficult to separate honest error from deliberate tax evasion. The basic law on tax evasion is contained in the US Internal Revenue Code section 7201, which states a person who willfully attempts in any manner to evade or defeat any tax imposed by this title or the payment thereof shall, in addition to other penalties provided by law, be guilty of a felony and, upon conviction thereof, shall be fined no more than $10,000 or imprisoned not more than 5 years, or both, together with the costs of prosecution. To provide tax fraud, to prove tax fraud, the government must find that the taxpayer either underreported his or her income or did not report taxable income. No minimum dollar amount of fraud must exist before the government takes action. Theoretically, a person can be prosecuted for underreporting even $1. In practice, the government usually takes legal action when there is a substantial underpayment of tax and when the evader either deposits unreported money in a bank or spends it. A second element of tax fraud is willfulness on the part of the tax evader. In the major case on this issue, willfulness was defined as a voluntary, intentional violation of a known legal duty and not the careless disregard for the truth. Finally, to prove tax fraud, the government must show that the taxpayer has purposely attempted to evade or defeat a tax payment. If the offender is guilty of passive neglect, the offense is a misdemeanor. Passive neglect simply means not paying taxes, not reporting income, or not paying taxes when due. On the other hand, affirmative tax evasion, such as keeping double books, making false entries, destroying books or records, concealing assets, or covering up sources of income, constitutes a felony. Tax evasion is a difficult crime to prosecute since legal tax avoidance is a favorite US pastime. It is often difficult to prove the difference between the careless, unintentional non reporting of income and willful fraud. The line between legal and fraudulent behavior is often so fine that many people are willing to step over it. In fact, it has been estimated that the underground economy may amount to about 33% of the nation's production. Working under the table and off the books ranges from moonlighting construction workers to gypsy cab drivers. There are an estimated 21,000 gypsy cabs in New York City alone, twice the number of legal ones. The Internal Revenue Service IRS estimates that more than $100 billion in taxes go uncollected each year because individuals fail to report all their income. Nearly a third of that amount is from self employed workers, including professionals, laborers, and door to door salespeople. The IRS may be losing the battle against tax cheats. The number of adults it conducts is actually declining. In 1980, it audited about 8% of all people whose income exceeded $50,000. Today, the number of audits has declined to 1.8%, and despite some well publicized cases involving the wealthy, such as a $16 million judgment against singer Willie Nelson, and the prosecution and conviction of multimillionaire Leona Helmsley. The IRS has been accused of targeting middle income taxpayers and ignoring the upper classes and large corporations. Thank you.